Welcome to TradeTheMBI.com. This is John. This report is for the 7th of April. And well, we're seeing the beginnings of more weakness out of the daily readings. We broke below the 25 on the MBI Magenta, which is usually an important threshold. We were already below, so we were already looking for softness to start, but we didn't have a significant rise in MBI white to cross over, so we expected it to be back and forth a bit, but now we've kind of crossed the threshold here where not only did we get the cross of the red, we've also reached a point where we're so close for white moving above magenta. When that happens, we know we're going to get much more significant decline within that. In that dip, we're seeing a nice buyback within that because, well, we're still in this shakeout with rising gold. If that begins to flatten out and start to roll over, and we're starting a new run upward of the shakeout histogram, that would spell some trouble. Now, we haven't quite dipped below the red line, so that's still not a horrible situation. We've just basically seen some softness reset, and that rejection that we noted the other day of DOC right here with the cyan moving above the green forms that little spider effect where it creates the little legs on either side. Also pretty weak from a general reading, and of course orange rising. Now we're getting to the peak point of orange. We're going to need to see that continue, otherwise a fade back down would be more of a support for bulls still within the soft side, and you're going to get that within these kind of short areas. What I look for is new lows and lower highs, and that's what you start to see as it builds up, and then it just starts to break free. And of course, there are so many macro issues that are negative from the Fed, knowing that it's so far behind the curve, it's not going to be able to catch up, and we're seeing that in rates. We'll take a look at TLT in that, which is treasuries, and the fact that, you know, we've got this inversion of short-term interest rates rising beyond what the Fed rates in a significant way. You're seeing mortgage rates significantly climb. Now, that's not a big deal when, you know, wages are rising and that, but as soon as you start to see a dip in employment and things like that, well, that whole scenario inverts quickly to a negative cascade. And it's that cascade that's always the unexpected part, where everything just seems to fall off instantly. And we've got plenty of precursors, the least of which are, you know, food and those kinds of things coming later. But obviously the maintaining of oil at elevated prices. NASDAQ faring far worse simply because of valuations on a lot of your tech stocks that are way higher relative to some of the base industries in the S&P. But you can see as the market is still going, we're still about 5 minutes from the close, but it's going to approach closer to the lows than the S&P did. And that's simply some of that secular rotation. And of course, further evidence the Fed's having troubles keeping the euro elevated. Really would like to see it above that 111 to that 118 range is more the ideal for them. But once you break below where we have the lows here at that 108 range, it gets to be very dangerous from Fed, well, and also ECB situation, because it's a flight out of euro into other assets, whether it be the U.S. Or other commodities like gold and or crypto, those kinds of things. And it's just a recognition that Eurozone as itself is not looking good and deteriorating quickly. Here we have gold standpoint again. Like I've said before, everyone expects that gold should skyrocket, and while it will in relative terms in time, as long as gold is treated as a paper currency, which is the primary function, you can just flood more paper onto it, even if you don't have the actual physical metals to keep price down. So it becomes a secondary control that central governments use to really keep things under wraps, so to speak. But again, that change with the Russians using oil and the ruble connected to gold really could pose problems in the actual bifurcation, where physical gold starts trading much higher than we see in futures contracts and also in paper gold markets. There's oil dipping below 100, and that was Well, an increase in supply, but also big inventory draws. Now, so the question becomes, is that because of slower economic activity or people just cutting back significantly in their usage given the price range? So that we're going to see when we start looking at unemployment numbers and things like that. If they start to climb, then we're beginning to see the real effects of changes in production, and or whether or not those shortages are causing companies to say, hey, it's just not worth me creating anything, so we're going to pause. Now, I've been talking about, up at the 145.50 range here, that we would be heading to the 125s for TLT, which is treasuries, in the expectation that the Fed would lose control of the interest rate narrative, and rates would have to rise unrelated to their actions. Now, of course, they're talking about potentially a 50 basis point rise in rates, which is thoroughly expected by most for me, but this is still going to be insignificant relative to what current inflation is running at and the prospects of where inflation is headed, particularly if, supply of products in that become limited, inflation can spiral even faster out of control. From a Bitcoin standpoint, again, pretty clean from the breakdown on NBI readings here. As the dip started below, we finally started to see an acceleration of the white NBI when it crossed with the dip below 25. And something I posted about, when you see that and then you're unable to get that NBI magenta back over 25, it's never pretty. So that's a perfect example of what I like to look for that in longer term runs, because you can clearly see that it continues to fade, and it makes it much easier to continue to short those aspects. And from Ethereum, ETH here versus the dollar, and plummet, the rise, again, all the same configurations that we look at. And when you get a nice rise pump with magenta, and it shoots above that 40 level, and you're not getting a boost over 50% more Fibonacci lines, you're going to have trouble holding that setup. And sure enough, it's been nothing but weakness going through there. From the ES 50K, I took that short going down. We had a little bump up. Took a short again here with the NBI white leading. And they haven't quite got the magenta breaking below yet, or below 25. If it does that, then I would expect the full lows to be retraced on that down to that 44.40 range. The interesting thing about the EES and that from a daily standpoint, above that 45.50 range, and all the net short talk gets flipped just from an option standpoint, gamma and all those related items to a buy signal. So that becomes a relatively interesting one to look at, and you see that's right up here where the 50K 76% is, but nonetheless relevant. It's still close enough. Breakdown though below 44, and now I think we're probably going to see much more selling take place as the environment has changed in some aspects, and others still not in the belief that, again, money is cheap, and as long as money continues to be cheap relative to being able to continue to borrow in that, to add into positions in that, you still have the potential for some very strong rallies within that. And this is where I say be flexible within those constructs, as I was posting on the Skype chat, and we just follow our readings. And it was pretty clean early on in the decay that took place. Then we started leveling out, and people saw an opportunity to take advantage of covering some of that setup, and that led to some bullish stints that were ultimately revisited back to the lower, and then it started building up here towards later today, which has been the practice. The plunge protection team, whatever you want to call the construct behind it, but it usually leads to some pretty fierce rallies, which is in fact what we ended up having before, creating a few positive extremes within the broader setup. Originally began with right there, that most recent dip here just filled it back in as we just closed the regular session right now. So we took another pop up with red leading, which is usually pretty negative for overall, but it stayed with magenta up until that crossover, which took place right about there at that previous algo level, 4481, and that's led to the most recent dip as we faded back here a little bit at the close. Now we're in the 15-minute post period before the pause and the beginning of the Asian Open. All in all, just fantastic action. I mean, this is just beautiful stuff going, and so I just say remain fluid with that, and recognize that you haven't reached a capitulation by any stretch, that things are going to completely turn south. There's plenty of people that believe that it'll all be okay. The Fed will step in and save the day with a halt of their tightening and move back to quantitative easing. But as I've pointed out at the beginning of the year when this all started, that the easiest way for the Fed to withdraw liquidity, and that was to create volatility, which would cause more traders in that institution-wise and otherwise to avoid those high-risk situations of large percentage moves and move to safety, which typically is in treasuries, which they were hoping would decrease the yield on the treasuries, but has not worked out quite like that for them, which is a bit problematic, and it hasn't helped those who flip to cryptos and things like that, because that's expressed similar weakness, because again, as long as it's traded in futures, they can take advantage of imbalances and pressure those setups further. So it's one of those where you just have to remain dynamic at this particular stage. That's something to be afraid of. It's something to capitalize on as we get these outside moves, which will create excellent runners, both long and short, to really create some outsized gains within the construct. So all good and exciting. I'm going to be in Venice all day for Thursday, so I will not be around for any of the Thursday action, but I will certainly be back again for Friday's report and get you all the latest details, and we'll see how it all works out. But clearly there's some headwinds that are becoming more evident to general market players, and have resulted in some fading of this massive bull covered short run that we've had recently. And interesting that this would take place given the fact that you had all this new fund money available and coming in, but I think that's where we'll see some of the dry powder of the institutional guys pop in whenever they feel that they've reached a threshold that's worth jumping in at. It might still be a little early for some of them. We also look at some of the buyback activity has kind of paused a little bit too, so there may be more than one set of or another looking for better deals or discount to attack at a lower level. So we'll keep an eye on it. As always though, trade well. We'll talk again later.